Welcome to Talk Tickers. We're diving into the latest from Hooker Furnishings Corporation today.
That's right. Their fourth quarter and full fiscal year 2025 results for the period ending February 2nd.
And our goal here is simple. Cut through the jargon, give you the key takeaways from their earnings call, what you really need to know.
Okay, let's jump right in with the top line numbers for the fourth quarter.
Yeah, what did they report?
Consolidated net sales saw about an 8% increase year over year, came in at $7.7 million.
8% sounds pretty good, but wasn't there something at the calendar?
Exactly. There was an extra weekend this quarter compared to last year, so that boosts the total number.
Ah, okay. So if you adjust for that, look at it per shipping day.
Right. If you normalize it that way, Hooker branded sales were actually up 2%.
Just 2%. Okay.
But Home Meridian, that segment jumped 13% on a per day basis.
Right.
Pretty strong.
Wow. Okay. And Domestic Upholstery?
That one went the other way, down 7% per shipping day.
So a real mix there.
Definitely. And the quarter wasn't clean either. They had $3.1 million in significant charges hit the books.
Charges like what?
Things like inventory write-downs from exiting their Savannah facility, some trade name impairment charges non-cash, thankfully bad debt from a customer bankruptcy, and costs for their reduction plan.
So those charges impacted the bottom line, I assume.
Oh, yeah. Led to a consolidated operating loss of $2.7 million for the quarter.
And net loss?
Net loss was $2.3 million, or 22 cents per diluted share.
Right. So Q4 had some positives per day in certain areas, but also these significant charges dragging things down.
Sure.
What about the whole year, fiscal 25?
Looking at the full year, consolidated net sales landed at $397.5 million.
Which was?
Down 8.3% compared to the prior year. And that weakness was pretty broad-based.
Across all segments.
Yeah, impacted all three reportable segments. They pointed to, weak demand, the depressed housing market, general macro uncertainty.
Makes sense. And the full year operating result.
A consolidated operating loss of $18.1 million. Big driver there was the lower sales volume, plus those charges we mentioned.
How much were the charges for the full year?
$10.8 million in total significant charges for the fiscal year.
Wow. Okay. And the final net loss for the year?
Consolidated net loss came in at $12.5 million, which works out to $1.19 per share. So definitely a challenging year overall.
Clearly facing some headwinds. Okay, let's dig a bit deeper. You mentioned exiting the Savannah warehouse. That sounds like part of a bigger cost-cutting push.
Absolutely. That Savannah exit is key. They expect about $1 million in cost savings just from that in fiscal 26. That's net of the transition costs, mind you.
Just $1 million next year. Does it get bigger?
It does. The annualized savings, once it's fully up and running, are expected to be between $4 and $5.7 million starting in fiscal 27.
Okay, that's more substantial. But there are costs to get there.
Yes, they do anticipate net charges related to the exit, somewhere between $3 million and $4 million in fiscal 26.
Got it. And this is on top of other cost savings, right?
Correct. They previously announced about $10 million in annualized savings. Now they're adding another $8 to $10 million on top of that.
So total target is?
They're aiming for total annualized savings between $18 and $20 million.
That's a significant number.
Yeah.
When do they expect to see the full benefit?
They expect all the plans to be fully implemented by the second half of fiscal 26, with the full run rate savings hitting in fiscal 27.
So a major focus on efficiency then. What's management saying strategically? How are they framing this?
They're emphasizing resilience, focusing on gaining market share even though the market's tough.
What highlights did they point to from fiscal 25?
Few things. The Margaritaville licensing deal, a new merchandising strategy for Hooker branded, expanding Sunset West on the East Coast, making some strategic inventory buys, and those market share gains.
And despite the losses, they see underlying improvement.
Yeah, they made a point that if you strip out those big charges, their financial performance actually got better sequentially each quarter through the year.
Interesting. So they see the cost cuts as the path forward?
Definitely. The accelerated cost reductions, like Savannah and also setting up a new leased facility in Vietnam, are expected to really help operating income and cash flow.
Vietnam. When's that happening?
Expected to be operational this May, actually.
And the goal there?
Reduce the need for domestic safety stock, improve product flow, help margins, and get faster returns on investment. Basically, streamline the supply chain.
Okay, let's break down the segments a bit more. Hooker branded, you said sales per day were up slightly, but what else?
Well, sequentially, from Q3 to Q4, net sales were up 10%. That was driven by a pretty solid 14% increase in unit volume.
So selling more pieces. How about profitability in that segment?
Operating income was down year over year in Q4, but it was an improvement from the losses they saw earlier in fiscal 25. So moving in the right direction, maybe?
And for the full year for Hooker branded.
Full year net sales were down 6.5%. Main reason was lower average selling prices, more discounting.
But volume was up.
Interestingly, yes, unit volume actually rose nearly 3% for the full year. So selling more but at lower prices.
What about orders? Any sign of future demand there?
Fourth quarter orders were up 15% year over year. That's a positive sign.
And backlog.
Backlog fell 22%. But they said that's mainly because their in-stock position improved, so they're fulfilling orders faster.
Okay. Anything driving that order momentum?
They specifically called out 2 new collections launched at the October High Point Market. Said they got a strong reception.
Right. Now, Home Meridian. That had the big jump in Q4 sales per day. What drove that?
Primarily strong performance in their hospitality business really kicked in during Q4.
And did that help margins?
Big time. Gross profit and gross margin saw significant improvement in the quarter for Home Meridian.
But still an operating loss.
Yeah, a small operating loss due to those charges hitting the segment. But the underlying sales and gross profit looked much better.
And the full year for Home Meridian, sales were down.
Down about 9% for the full year. That was mainly because volume dropped quite a bit as they consciously exited some unprofitable lines.
So a strategic shift there too.
Exactly. They're focusing on growing the Pulaski and Samuel Lawrence furniture brands, which tend to be higher margin, and getting out of some of the lower margin stuff.
And that helps with.
Improves the margin profile, obviously, but also lets them reduce their warehousing footprint, which ties back to closing the Savannah facility.
Makes sense. Okay, last segment. Domestic upholstery. Sales were down.
Yeah, down about 7% in Q4 year over year. They just cited soft demand.
Full year.
Down about 10%. And the segment posted an operating loss in the fourth quarter.
Any bright spots there? Orders, maybe?
Actually, yes. Fourth quarter orders were up 13%. Saw good growth at Bradenton Young and HF Custom.
And Sunset West.
Yeah.
You mentioned their expansion.
Sunset West had its 4th straight quarter of order growth. Seems like that East Coast expansion is paying off.
Interesting. And they see an opportunity here despite the soft sales.
They do. They talked about a tremendous opportunity potentially opening up.
Why is that?
Tariffs. The idea is that if tariffs make imported upholstery more expensive, retailers might shift more sourcing back to domestic producers like them.
Okay. A potential tailwind to watch.
Yeah.
So, putting it all together, how does their financial position look? Cash on hand.
At the end of fiscal 25, they had $6.3 million in cash and equivalent.
It was down from the year before.
It was down, yeah. Main reasons were higher accounts, receivable money owed by customers, and also that strategic inventory build, particularly in Hooker branded.
So using cash deliberately. Anything else?
Regular stuff too, paying dividends, spending on their ERP system upgrade, other capital projects.
But has the cash position changed since year end?
Big time. They mentioned that as of yesterday, so very recently, cash was up to nearly $19 million.
Wow, quite a jump. How?
Likely just timing of payments and receivables collection, plus they have access to more funds now.
New credit agreement.
Yep, they refinanced their credit facility.
Yeah.
Gives them $41 million in available borrowing capacity, so much more liquidity now than at year end.
And that inventory build in Q4, just to be clear, that was planned.
Yes, definitely framed as strategic. To support the new collections, restock popular items, improve availability overall, and maybe hedge against supply chain hiccups.
And they're still paying dividends.
They are. Announced their regular quarterly dividend. They highlighted their long track record of uninterrupted payments. Important for some investors.
Okay. So they're managing finances, cutting costs. What's their take on the overall market outlook? Still cautious.
Very much so. They flagged significant economic uncertainty, pointed specifically to existing home sales being at a 50-year low. That's a huge headwind for furniture.
Yeah, tough to sell furniture if people aren't moving.
Exactly. And the potential for more tariffs adds another layer of complexity.
So what are they doing about it?
Actively evaluating strategies, looking at more operational consolidation for efficiency, basically battening down the hatches, but still trying to grab share.
Any glimmers of hope?
They did mention inflation showing signs of cooling recently, and that year-over-year monthly furniture sales actually started ticking up back in September 2024. Small positives, maybe.
And strategically, what's the big bet?
Seems to be this collective living merchandising strategy, trying to integrate the offerings from their different brands, present a more unified front to the market.
Like with those new collections that did well.
Precisely. They see the positive reception there as proof the concept works and that it'll be key for future success.
Okay, makes sense. Let's shift gears slightly. Time for our not financial advice segment. Based on all this, any outrageous but plausible trade ideas spring to mind?
Well, thinking about those cost savings, $18 to $20 million annualized is a big number if they can actually hit it.
And the domestic upholstery angle.
Right, that potential tariff tailwind. So one idea, definitely outrageous, possibly plausible, is a straight long position on Hooker Furnishings.
Betting that.
The betting that the market isn't fully pricing in the potential profit improvement from those cost cuts, and maybe a tariff-driven boost to domestic upholstery. If those things materialize faster or bigger than expected, the stock could re-rate.
What's the big risk there?
Obvious ones. The housing market stays terrible. Tariffs don't help them as much as hoped or don't happen. And critically, can they actually execute and deliver those cost savings? Execution risk is real.
Okay, interesting idea. Got another one.
How about a pairs trade? Thinking about Home Meridians specifically.
Because of the hospitality strength and focus on better brands.
Exactly. Strong hospitality, focusing on Pulaski and Samuel Lawrence, exiting low-margin stuff. That seems like a relatively stronger part of their business right now.
So long Hooker, short.
Short a competitor that's maybe more reliant on those lower-margin, import-heavy categories, maybe less exposed to the recovering hospitality sector, and potentially more vulnerable to tariff pressures.
Kind of leveraging the internal shift within Hooker's business.
Yeah, playing the relative strength of that Home Meridian strategy against a weaker competitor profile. Again, lots of ways it could go wrong, but it fits the outrageous but plausible bill.
Definitely food for thought. Okay, that about wraps up our deep dive on the Hooker Furnishings earnings call.
We've hit the key numbers, the strategic moves like cost-cutting and the Vietnam facility, the segment performance, and the outlook.
And remember, as always, this was purely for informational purposes. Definitely not financial advice. Please do your own homework.
What stood out to you from this? Any questions still lingering about their strategy? Always good to dig deeper yourself.
Join us next time on Talk Tickers, where we'll unpack another key earnings call to keep you ahead of the curve.